Happy New Year, etoro. It is the beginning of January 2022, and so I wanted to look back through 2021, see what worked, what didn't, and what might need to change. Let's take a look. Looking at my annual returns, it is pretty obvious that 2021 was not a great year for my portfolio, with a return of minus 2.2%. I haven't hit my targets within 2021, despite the S&P 500 putting in a pretty strong annual return. My goal, for those that don't know, is an annual return of 30% per year. Obviously a pretty major miss in 2021, but through 2019 to 2020, I provided a return of over 100%. So actually through the lifetime of eToro, my return is above 30% per year on average. Now I know for those investors that joined me in 2021, you probably don't care very much about the returns before you joined me. You just want to see good returns going forward. And I think that 2022 is going to be a fantastic year for that. Looking at the major US indices, so the candles are the S&P 500, the green line is the NDX, NASDAQ 100, and the blue line is an ETF that represents the Russell 2000, the 2000 smaller companies that are listed within the US. So the S&P 500 has marched upwards and to the right for much of the year, although it's been a fairly volatile year. The NASDAQ had a bit of a tough start. The NASDAQ 100 had a bit of a tough start. You can see that around May, it returned almost to the levels that it was holding at the beginning of the year before rising quite nicely, through the rest of the year. The NASDAQ has underperformed the S&P 500 last year, which is fairly rare over the past decade or so. And the Russell 2000 has had a tough year. It's been stuck in this range more or less. It had a peak roughly in the middle of March, nearly climbed out of that peak in November, but then retreated towards the end of the year, back within that range. My portfolio has tracked the IWM, the Russell 2000, more than the other indices. I haven't held a lot of mega caps through this year, the exception being Amazon, which is the largest position in my portfolio right now. Last year has been a year of rotations between growth and value. Some years we see a few rotations. This last year saw some fairly large rotations, and that's part of the reason that we saw some of the volatility that was evident in the indices. The major winners over the past year were US energy, US real estate, US financials, so banks, large banks, and the mega cap tech stocks. If you were invested outside of the US, you would have had a very difficult time beating the market, particularly in the second half of the year. The first half of the year was a bit easier. The second half of the year was tough outside of the FANGs. To illustrate this point, there are various ways of slicing and dicing this data, but I'm looking at this chart on screen right now, and the chart is the market cap share that the FANGMAs, Facebook, Amazon, Apple, Netflix, Microsoft, and Google, have of the S&P 500 as a percent. We can see that through 2020, the share reached an all-time high and then dropped off slowly through that year and part of 2021, and has risen aggressively through the second three quarters or half of 2021. This is important because the indices have all been marching, well, not all, but the S&P 500 and the NASDAQ 100 have been marching higher. But this is not because of that all of the stocks, or even a large number of the stocks within those indices, were marching higher. Particularly the NASDAQ 100, it was the mega cap stocks, the FANGMAs, that were carrying those indices higher because of how large they are. A very large number of companies within the NASDAQ 100 and the NASDAQ composite actually are in bear market or correction territory, even right now. I wanted to talk very quickly about my strategies through 2021. There were a variety of strategies, but I wanted to focus on those that didn't work out. At the beginning of 2021, my portfolio through the previous 2 years had done very, very well, being focused predominantly in US stocks. A lot of US stocks have become very expensive, and it felt as though there might be a migration, at least of some of the capital in the market, outside of the US market and into other geographies. One of the geographies that I looked at was the Chinese market. I've been invested in China for many years, but usually with a much smaller allocation than I had through 2021. Now on screen, I'm looking at the CQQQ, which is an ETF that represents Chinese technology, and you can see that there was a huge spike and then a sell-off in Chinese technology companies. The run-up was too much and too fast. And then around the March, April kind of time frame, it felt as though a buying opportunity was presenting itself. The drawdown for many fantastic businesses in China was more than 20%. Those companies had entered a bear market of their own. And given the fundamentals of those businesses, it felt like a fantastic time to buy in. Now, we know much better looking backwards. We have a lot more information, obviously, because we're looking back through time. We know that the Chinese government was quite aggressive in rolling out a huge amount of additional legislation and fines, etc., 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 and that went on for many, many months. But at this point in time, we didn't know any of that. And it looked like these companies were a great, great opportunity. And so I increased my allocation of Chinese companies around this kind of time frame. Now, subsequent to this, we heard a lot more out of the Chinese government, and there were a few other risks that emerged. For example, the concern about Chinese companies delisting and the structure under which Chinese companies list within the US. Now, at the time when we got a lot more information from the government and we knew that this was going to continue for a number of months, I began to sell out of a number of my Chinese equity positions. That was roughly in the July timeframe. But, by that point, some damage had been done. So I did save the portfolio from additional losses, but there were a decent number of losses that had already been incurred. So this was one of the things that hit the portfolio through this year. The second geography that I invested fairly heavily in was the UK. Unfortunately, we don't have an ETF or a representation of the UK market in etoro outside of the UK 100. So this is the FTSE 100. But this is skewed because these companies tend to be international and they are very, very large companies. But anyway, I'm going to try to use it as an illustration. The UK economy was hit by the double whammy of Brexit, as well as the pandemic. So the initial handling of the pandemic seemed to be very poor within the UK. This really hurt sentiment in terms of drawing investors into the UK market. And the UK through 2021 actually, the FTSE 100 had one of its best years in the past, I think, 5 years. But that doesn't mean it was a particularly good year anyway. It's fairly widely acknowledged amongst investors and economists that the UK stock market is a massive opportunity. A number of the companies in the UK market are trading at a significant discount to their counterparts in other geographies. However, the sentiment is still so strong around Brexit and the pandemic that this hasn't been a big enough draw to see large inflows just yet. So despite the growth that we've seen in the FTSE 100 through the past year and a nice fat candle today, you can see that the index is still below its pre-pandemic levels, which is crazy compared to the US markets, which are well above their pre-pandemic levels. If we look at the FTSE 250, so these are smaller companies within the UK, this index, the companies in this index have done a little bit well than those in the FTSE 100, but not that much better. These companies in this index are only just beating the level that they were at pre-pandemic. Now, at one point, my allocation to stocks within these geographies made up 35% of the portfolio. So when these companies in these geographies experienced large drawdowns, they obviously affected the returns of the portfolio. It's not all bad news though. So the returns of investment in those geographies were significant enough that they massively depressed the returns of the overall portfolio, but there were still a number of strategies that were working out. And you can see these by looking at the profit and loss, the 1 year profit and loss for my portfolio. So there are a number of positions that I had closed out in profit through the year running from the 4th of January 2021 to 4th of January 2022. And the return on these positions is roughly 20%. Now, the natural question is to ask, how can the portfolio overall be negative for the year when the P&L, the realized profits for that year, are nearly 20%? And that is because I was taking those profits and reinvesting them in various areas within the portfolio, those downtrodden stocks that are presenting fantastic opportunities for the coming quarters and years. Now, I know that some people will be watching this video and say it was obvious that China was going to do what it did. It was obvious that the UK market was going to underperform the US market, but I don't think it was at that point in time. And I've spoken about this before, but hindsight bias is a bias that affects all humans and investors, and it makes us think that past events were more predictable than they actually were. We now have the information that shows us that those economies, those geographies weren't great areas to invest. But at that point in time, I don't think it was so certain. If it was so certain, I think we'd have a lot more trillionaires walking the streets. Okay, so I've spoken about parts of the strategy that didn't work out through 2021. What about mistakes? So all investors make mistakes in any given year. The idea is just to make fewer mistakes than you have successes. However, I think that through 2021, I made more mistakes than I usually would. And having thought about this at length, I think the primary reason is that was the first year I became a full-time investor. This was the first time that I had my entire days, well, nearly my entire days devoted to analyzing, researching, investing, etc. And this changed the way that I did things a little bit. The two main areas that I think it affected me the most was that I added a lot more assets than I historically would have. I had more time in my hands. I love looking at good companies, finding opportunities, those things that other people have missed. And I added way too many assets to the portfolio. So this meant that instead of focusing my attention on a few good companies, I was splitting that attention across a much wider set of companies. And this meant that maintaining that portfolio became a bit of a nightmare. I have now, so I think I started at the end of Q2 cutting back the number of positions, and I'm sitting at roughly 30, maybe 32 positions, and I might even get that lower, closer to 20 over the coming months. The second mistake that I made is that I was over trading. Now, I wasn't day trading. I wasn't trading like crazy. I wasn't, buying and selling 10 different things every single day, but I was trading more than I usually would, more than I had done through the past few years when I have been very, very successful. Again, I think that this was a product of, for the first time, being a full-time investor. So talking to people, looking at screens all day long and feeling like I should be doing something. And it's true, I should be doing something, but that something is more along the lines of analysis and deciding when not to act. So some of my strategies didn't work out, and I made some mistakes. But I also wanted to call out a difference between making mistakes and making good decisions that have bad outcomes. We as investors or traders, whatever you might be, business owners, basically anything in life, you can make good decisions based on the information you have, but still experience poor outcomes. An example is when you flip a coin, you know that half of the time you're going to get heads or tails, but there might be periods where you get a lot more heads or a lot more tails in a row. In the same way, as a business owner or investor, you might make a number of good decisions and get poor outcomes. This doesn't mean that you should stop making decisions or change your decision-making process. It just means that you need to continue for longer. In the same way that flipping that coin, you might get 6 tails in a row and 2 heads in a row. Over 1,000 flips, they're going to end up being 50-50. So I think part of my result through 2021 was making good decisions, but getting bad outcomes in some areas. This doesn't mean that I'm not taking responsibility for the performance of the portfolio through this year. I most definitely am. I'm the person that's making all of these decisions. I just think that sometimes you don't get the results that you want in the time frame that you want. It is the market, after all. Okay, so what have I changed that's going to mean that I don't make those mistakes again? I've reverted a part of my strategy back to the way that I used to do things before I was a full-time investor. I've pulled up the KISS principle on screen. This comes from software development, and it is an acronym that stands for keep it simple, stupid. The stupid in this case being me. So the two things that I have been doing through the second half of this year are, first of all, as like I said, reduce the number of positions in the portfolio so that I can focus on those companies a lot better. This means that there's going to be more volatility in the portfolio. Fewer positions means that the ride is a little bit less smooth, but that's okay. And the second is to trade less, to buy and sell less, to buy something that's within my current plan, look at my plan every time I feel like I should be buying or selling something and realize that I shouldn't and that I need to wait. This doesn't mean not doing anything all the time. It just means that I act when I really, really need to. Now, I know that the second point actually frustrates copiers and followers. There are people that when the market is in a downturn or a stock is tanking, they feel that I should be doing something. A thing needs to be done. A hedge, a buy, a sell, something. And quite often that is not the case. I like to illustrate these points using examples. So I've got Micron up on screen. This is not the first time that I've spoken about such an example. Imagine you bought Micron, let's say in July 2019, and unfortunately it then dropped 15%. Now I'm assuming that you know the company, you know the industry, you know its prospects, you know it's a growing industry, you know they're a fantastic company. It hurts, right? You bought something and a few days later it's minus 15% down. That sucks. But because you know what you're doing, because you've done your research, because you know what you own, you're willing to wait it out. And so you ride this volatile trail, and roughly 1.5 years later, you're sitting on a 96% profit, 97% profit. A fantastic return for 1.5 years worth of investment. However, if you had listened to the temptation to try and buy and sell and hedge all along this wiggly path towards this 97% return, I am pretty sure that you would have made less than this amount ultimately and potentially lost money. What about 2022, so the current year that we are in? Now, forecasting is a bit of a fool's errand. Humans are very bad at predicting things, but we need to start somewhere, have some kind of a plan, and then adjust as new information comes to light. So far, based on what we know today, it looks to me as though we are close to getting over the coronavirus hump, and we will return to something like normality fairly soon. I think that becoming a properly normal world is going to take a while. And by while, I mean years. I also think the market's going to acclimatize to this new world in which rates are rising. So we'll see fewer knee-jerk reactions to that type of information. I think the volatility that we saw through the last quarter of 2021 was very good, very healthy for some companies. And we've got very good companies that have formed pretty good bases. And I think they're going to have great years, not just 2022. They are good companies, and their share prices will reflect that through the coming years. I also think that supply chains are healing. It's more than a thought. I can see it in the data. Various bits and pieces of information. Supply chains are becoming better again, and because so much of inflation was because of supply chain issues, inflation is likely to start cooling off. Again, this is not something that happens overnight. It's probably going to happen over the next few quarters. But as that happens, I think that central governments might start being a little bit less aggressive in terms of their plans for interest rate hikes. US corporate earnings growth seems to have peaked somewhere in Q3 and Q4 last year. We'll see. Earnings are about to arrive in the next few weeks. We might see some big moves in stocks because of this. There might be a few surprises, but there will still be companies that are strong companies that will grow well. I also think that global GDP will continue to be strong. And lastly, we've seen some evidence of this already. China is starting to loosen their economic policy. Last year, they took a number of actions in order to make sure that their economy, their society was healthy. And now I think they're going to light a little bit of a fire under their economic growth to speed it up once again. They want to be growing. So finally, in summary, some of it will repeat what I said at the beginning. My lifetime target for my portfolio is to create a return of 30% per year. Having a return of minus 2.2% in 2021 doesn't feel good for me. It doesn't feel good for copiers. I understand that. But given my strategy, I think that there will be volatility in the portfolio from time to time, sometimes for years at a stretch. My portfolio returns from the beginning of 2019 through to the end of 2020 were over 100%. I don't think that is a sustainable level of return. And so in some ways, having a poor year through 2021 makes me feel a lot more confident in having good returns in coming years. For those of you that have continued to copy me through this year, thank you very much. I know that being patient is hard, particularly when there are people around you that are making more money than you are. I really do think that 2022 is going to be a fantastic year for the stock market, particularly as the world returns to some kind of normality. All right, that's it for the review of 2021. Thank you very much for your time, and I'll speak to you soon. Goodbye.